What is a bond? Remember my rule. You can't invest in something unless you truly understand what that thing really is. A bond is just an IOU by a company. An investor agrees to loan a company money, and a company issues them a bond. The investor is now called a bondholder, and the company is called an issuer. So bonds are simply a way for governments and companies to borrow money. Issuing a bond is usually less expensive than going to a bank and asking for a loan, and it offers the company or the government a little bit more flexibility in terms of their borrowing. So the thing is, no one's going to lend their hard-earned money for nothing. The issuer of the bond, the company, must pay the investor, the bondholder, something extra for being able to use their money for a specified period of time. So I made sort of a simple diagram here. You see there's a person on the left and the company is supposed to be on the right. So this is you, and here's the company giving you a bond. Pretty much that simple. So you all must be wondering, okay, so what's the difference between stocks and bonds? We talked about stocks last week. Now we're talking about bonds. They seem pretty similar, right? Well, as an investor, I'm still giving money to a company, but these two things are different. Stocks are equities, bonds are debt. As a stockholder, you own a stake in a company. You have a right to share in the future profits of that company because, remember, you literally own a proportionate share of all that stuff that that company is made up of. But you have no guarantee that you get any of your initial investment back. You hope that your stock appreciates in value, and you hope that the company has enough money left over at the end of the year that they decide to pay their stockholders a dividend, which, remember, is like interest. But none of this is guaranteed. And the only way for you to monetize your investment and get your money back is to be able to sell your stock in the open market for more than what you bought it for. So it can sound a little risky. Bonds, on the other hand, generally tend to be a safer investment. With bonds, you lend money and become a creditor to the company. So you don't have the right to share in any future profit, but the company does legally agree to pay you a coupon, semi-annually or monthly in some cases, and they're legally obligated to pay back your entire investment at the end of the life of the bond. So you have at the top an issuer, the person who actually issued this bond. This is just a company who borrowed money for the government. You have a par value or face value, and you can think of this as the denomination of a bond. Most bonds have 1,000 denominations or higher, but sometimes in the case of government bonds, it can be 100,000 or higher. When a company issues a bond, they usually borrow a lot of money, and I'm talking $250 million or more in some cases. That would be deemed the amount outstanding or tranche size, as you see a little bit towards the bottom of this slide. You also have the principal amount, the amount you're willing to lend to a company, and the amount you should give back when the bond matures. Then you have the maturity date, the date in the future when the investor's principal will be repaid. You also have the coupon rate, which is important for people that really care about current income. That's the fixed percentage that is paid to the bondholder by the company, usually semi-annually, but as I said before, can be monthly too. And then you have bond credit ratings, which I will talk about in more depth in the next slide. And finally, you have yield to maturity, which you can think of as the percentage return on the bond if you were to hold it until maturity. So now, it kind of makes sense why bonds are considered fixed income. The income on the bond is fixed. You can literally map out every cash payment you're going to receive from this issuer based off of these defining characteristics of the bond. So, now you've seen a bond, you understand what it is, but how does it really work? Bonds are all about cash flows. You make money from investing in stocks only if the stock appreciates in value. But owning a bond allows you to make money every 6 months practically. The issuer is legally obligated to pay you a coupon and your initial investment back. So for this reason, bonds are great assets for investors seeking safety and steady income. Think retirees. So we have a diagram here of the cash flows. You can see that every 6 months you are getting paid the coupon on this bond, which looks like it's 4%. So you may be saying, wait, why is it 4%, not 2%? It looks like it's $20 there. Well, you're getting $20 every 6 months. That adds up to $40 a year. The coupon is an annual figure, so that's why it's 4%. And at the end of the life of the bond, when it reaches its maturity date, you receive that last coupon payment as well as the initial principal you invested. So finally, now that you understand what it is that you're investing in, how do we actually go about investing in bonds? We reviewed last week opening up a brokerage account, and once you have that open, you're able to invest in bonds. The bonds are generally considered safer than stocks, and for diversification purposes, my view is that bonds belong in every portfolio. Remember, the likelihood of your loss of your original principal is low, and you also receive income on a set schedule. The issue is, though, that investing in an individual bond, like that General Electric 2024 bond that we talked about in a previous slide, it tends to require minimum denominations of either $1,000 or in some cases $100,000. That's way too much for most people. It's way too much for me. So most investors use bond mutual funds and bond ETFs as a way to invest in bonds. And there are many options that you can take in terms of issuer and in terms of maturity. There are government funds, corporate funds, long duration bond funds, short duration bond funds. We didn't talk about duration here, but that's another way to sort of define what a bond is or the characteristics of a bond. There's funds for just high quality companies. There are funds for low quality companies. But I would say an optimal bond portfolio would be a mix of both government and corporate bonds of varying maturities. Remember, the bond market is 2 times the size of the stock market, so there's a lot of different options. And I actually put on this slide just a couple bond funds that have done well in the past and have high rankings, but do your research. There's many different funds that you can invest in.